This podcast is general in nature and hasn't taken your circumstances into account. It's important you consider your personal circumstances and speak to a financial advisor before deciding what's right for you. Any general tax information provided is provided as a guide only. Now, here's Shane and Deanna.
G'day everyone, welcome to this week's podcast. Deanna is travelling this week. She's gone off to Darwin, believe it or not, and so that left me behind with my colleague, Me Boo, who is an economist in our team, and she's filling in for Deanna. So welcome, Me.
Hi, Shen. So the biggest headlines in the news in the past week is that CoreLogic home prices reached a new record high. Can you break it down for us?
I sure can. These numbers have surprised me. I must admit, I never expected property prices to take off like they have over the last 12 months, given the rise in interest rates, because when interest rates go up, and they've gone up a lot, as many people listening to this or watching this would know, when you show up at the bank, you can't borrow as much. So that's a big drag on the property market. But property prices have gone to a record high, as you indicated, not just on the CoreLogic data, but also data from PropTrack, which is an alternative data source for property prices in Australia. And of course, a lot of it recently has been driven by three cities, Brisbane, Adelaide, Perth. They've been benefiting from a shortage of listings. Any property that comes onto the market in those cities is snapped up pretty quick. So listings are running something like, total listings on those markets are running something like more than 30% below their 5-year average. And of course, Brisbane and Perth are also benefiting from interstate migration. People saying, well, Sydney's too expensive, I'm going to move away. And that adds to demand in those cities. Of course, below them, it's quite a bit softer. Sydney has clawed its way back to around its previous record high, which was back in January 2022. But other cities are still quite a bit below, Hobart, Darwin, Canberra, and so on. So it's a bit of a mixed bag across Australia. But the key factors which have driven all of this have been obviously got this dampening impact from high interest rates. But the key factor, of course, has been the shortage of supply, massive population growth, and we're simply not building enough houses. We're building something like 170,000 dwellings a year. We should be building something like 250,000. So last couple of years, we've had a shortfall of 80,000 or so dwellings per annum. You add that to the existing shortfall and we're pushing around 200,000 to 300,000 total shortfall in Australia. And that's what's been pushing the prices up.
Sounds like a tale of three cities to me. Perth, Brisbane, Adelaide, you said. So what's going on in Melbourne? I thought property prices there are actually going down at the moment.
Well, they have been pretty soft. It seems to me Melbourne's got this hangover from the pandemic, which has depressed people in Melbourne to some degree. We've actually seen quite a big increase in listings in Melbourne. In fact, they're running almost the opposite to the other cities. They're running well above their 5-year averages and well above where they were a year ago. So that's putting a dampener on. And that does provide a bit of a warning sign, as does Hobart, which has also been going backwards, that, high interest rates can have an impact. We saw that in 2022. And what I think we're starting to see, particularly in Melbourne, is more distressed listings. People saying, well, prices have gone up a bit, but I'm struggling with my mortgage. I kept hearing rates are going to come down, but that keeps getting delayed. Maybe I should get out now while I can. And I think that may be a factor in Melbourne. And the risk is that the longer rates stay higher, that you may see that spread to other cities.
Interesting. It sounds like the colder you are, Melbourne, Hobart, the more property prices going down.
It is almost that way at present.
From a young person's perspective like me, say if I'm not in the market yet, I actually want prices to go down, like Melbourne and Hobart, because I want a place as well. I think most surveys actually indicate that millennials and Gen Z actually want to buy a house, but they just can't do it because affordability is at all-time lows right now. And then if you think about it, property prices are generally driven by supply, demand, affordability, and rates. So if you go through any of them, demand is still going up because of population growth. Supply is not going up as much because you said property approvals actually running way below demand. Affordability is still very bad. And rates, they're very high right now, but there's still a chance of rate cuts next year. So if you look at any of those points, it looks pretty much hopeless for any of us who want into the property market.
Yeah, it's depressing. I find it depressing because when I was young, I'm a baby boomer. At one point in time, they were young. I was able to get into the property market into nice parts of Sydney. And I kind of think if my wife and I, versions of us came along today, we couldn't do the same thing. It'd be a lot harder. The Aussie dream was always about affordable housing. That seems to be becoming a distant memory now. And of course, each new generation, when they manage to get in, like millennials, they say, well, I'm in here now. I want prices to keep going up as well. And so no one seems to fix it up. Now, fortunately, this government, the Labor government in Canberra, has put more focus on supply, which I think is great, commendable. There is a focus around Australian cities, particularly Victoria or New South Wales and Victoria, doing more stuff. So that is good news, but it's going to take a long time to come through. I think the reality is we need to focus on building more units. We can't just rely on building lots of standalone houses like we used to. And we have a capacity industry in the home building industry. Obviously, it takes a lot more capacity to build a standalone house than it does a bunch of units. So that has to be where some of the focus is, more focus on social and affordable housing. We need to get the approvals for these new projects up and done quickly. But I think more fundamentally, we need to find different ways of living. We're jamming people into a handful of already big capital cities where there's limits to how much you can put in there without reducing quality of life in those cities. So I think longer term, we need to be thinking about focusing more on places like Bendigo and Bathurst and away from the regular capitals. And that requires infrastructure spending. So it requires a short-term focus, get more houses made, but also a longer-term focus. And I'm feeling a little bit optimistic here, but I think there's a long way to go. And things, unfortunately, could still get worse before they get better.
It's funny you mentioned Bendigo, Ballarat, because as an immigrant myself, I know a lot of immigrants who try to get into these short-term shortage of skill visa, and they give extra points to people who stay in these regional areas. But then what happens is that after people get their permanent residency in those, regional cities, they've moved back into Sydney and Melbourne because there's not much to do in those cities.
Well,
and that put extra strain on Sydney and Melbourne again.
It does, and I can understand why you might want to be in Sydney and Melbourne. I mean, you might see it as more exciting, more ritzy sort of stuff. But by the same token, I think the pandemic and the working from home phenomenon showed that there is a different way. There will be some people who want that lifestyle change and will want to be in those cities. So it's finding a way to encourage those who want to move out to those regional centres, and those who want to, providing space for those who still want to come. And so I can sort of understand why people want to be in a Sydney or a Melbourne or a Brisbane. But ultimately, we really need to go down the US model where you've got lots of mid-sized, smaller cities, which are great to live in, good quality of life with lots of jobs. I mean, that is the ideal. America did that by having great infrastructure, and that made that possible. I think we need to think perhaps along the lines of doing the same thing.
That's a great idea. And that brings us a bit of hope as well, I guess.
Hopefully. The way it's been going in the last 20 years, it's been going the wrong way. So hopefully we start to see some positive action.
Actually, in one of the recent reports by AMP, I saw the statistics that 4 out of 5 baby boomers don't want to downsize, don't want to move out of their homes.
That's a problem. And I think you're right. We should find ways to facilitate baby boomers downsizing. So it frees up family homes for younger people after the baby boomers and Gen Xers become empty nesters. And there's a couple of things that need to happen there. One, we need to give baby boomers and Gen Xers, when they retire, financial security. So when they retire, they can feel comfortable with the savings they have, that will see them through for the years ahead. So there's an issue there. Financial planning can help. Government can help, letting people know what they need and whether they've got enough or not, and giving them that confidence. And also investment products can also help along those lines. So that's part of it. I think reforming stamp duty is another big part of it. A lot of baby boomers say, well, if I sell this family home, I'm going to then incur a lot of stamp duty when I buy a new property. So that eats into my wealth. So reforming stamp duty, I think, would be a big part of it as well. And one of the main arguments to get rid of stamp duty and replace it with a land tax is to encourage baby boomers or retirees to exit the family home. But unfortunately, that call seems to be falling on deaf ears. But it is certainly something that I think we need to think more about, just giving baby boomers and Gen X the confidence to downsize and making it easier financially for them to do that. So apart from the housing data this week, we saw the GDP numbers, and to me they look pretty bleak. They're not disastrous. We're not in a technical recession yet, but they did show the economy growing at just 0.1% in the March quarter. And so what did you make of those numbers, Mee?
0.1% is barely growing, right? So if you look at it on a longer term basis, in annual terms, so over the 4 quarters, Australian economy grew just 1.1%. This is the slowest result since 1990s recession and slowest outside of the pandemic, of course. And I thought that this is a pretty bleak result. It was lower than what we expected, lower than what markets expected.
I think it's also lower than what the RBA was forecasting.
That is true. The RBA was forecasting roughly 1.3% growth by this quarter already. So over the last year, we have 2.5% population growth. The average normal growth rate for GDP in Australia should be closer to 2.75 to 3%. So this is like barely half of that. And that's pretty depressing to me as well, because that means that living standards as measured by GDP or output per person is actually going down. And it has gone down for 5 consecutive quarters.
Again, that's the worst. I think that's the worst outcome since the early 90s recession. And most people wouldn't even remember that. I remember it. I was early in my career, but that is a fairly bleak outcome. One of the big surprises I thought in the GDP numbers was consumer spending, which we were thinking would be 0. I think it was up 0.4%, but it looks like gambling and Taylor Swift played a role in that.
Yeah, that's true. Part of that was people going to more sporting events over the quarter. But I would put that into context. So that actually rebounded after a massive contraction in the previous quarter, number one. And 2, people are actually still spending the bulk of their money on essential items. So that's electricity and utility bills, that's rent, and that's also food. And all of those items, the prices are still going up and taking up a massive portion of disposable income from people.
Yeah, I saw something that said essentials are up 0.5%, spending on essentials. Consumer spending was up 0.4%, so the bulk of it was essentials.
Yep.
And population growth was also 0.5, 0.6%. So virtually all of the growth in consumer spending was just natural growth, or I wouldn't say natural growth, but growth in the population. More people here, more spending on utilities and rent and food and stuff. I guess the big question is what this means for the RBA. I mean, we just talked about the GDP numbers being less than the RBA was forecasting. I mean, my inclination is to think that we'll still see a rate cut by year end. I must admit it's a risk that we could be delayed into next year, but with the economy so weak, you'd have to expect that inflation will fall in response to that.
Speaking of that, inflation data actually bounced up a little bit last week to 3.6%. We thought it would be, 3.3, 3.4%. Would that delay the RBA a little bit though?
Well, that's the big question in all of this. My inclination is to think, well, no. But we could see that is a risk. It did go the wrong way in the month of April, but we also know those monthly numbers can be quite volatile. There was a seasonal aspect to it. And the RBA might say, well, they were forecasting 3.8% and it's 3.6%, so it doesn't necessarily change our forecast. And if the economy is weaker, they'd probably still be in a position to leave their forecast for inflation to fall back to target in the next couple of years in place. And we did hear from Governor Bullock, and that was before a Senate inquiry. I don't know where that came from. I didn't see it in the diary beforehand, but suddenly that popped out of nowhere. Indicating that, basically she seemed to reiterate what she'd said back after their May meeting, that they don't want to rule anything in or out. But obviously if inflation looks like coming down more slowly, then they might have to act again. But I didn't get the impression that it really changes the outlook. And I tend to think that inflation is usually a lagging indicator. We know that when people spend less, it's harder for companies to raise prices, and that ultimately pulls inflation down. So to my view, I think they're still on track to cut rates, hopefully by later this year. But I do worry still that if we leave it too long, we could slide into recession. I think that's it. I hope that was of value. Thanks, Mee.
Thank you, Shane.
Take care, everyone.
For more info on Shane and Diana's podcasts and reports, head to the Insights Hub at amp.com.au.